Good afternoon, everybody, once again, and welcome to our exclusive advisor webinar, the BetaShares webinar on hybrids, risks, pitfalls, and opportunities. We're really excited by the number of attendees we have here today. It seems as though hybrids is a very pertinent topic for you advisors, and we look forward to giving you some insight and education on some of the risks, the pitfalls, and indeed the opportunities of hybrids. Before we start, just to mention, this is general advice only, should not be construed as personal advice. Obviously, as advisors, you'd be aware that you should look more closely at the PDS and any other disclosure material to find out more about the product and what we're talking about today. Also, a little bit of housekeeping to start off with. Everyone who is registered for the session will receive a recording, which you will get post the event via email, plus some information on the hybrid fund. There'll also be an opportunity to ask questions. You'll see in your widget there's a questions and answers section. Please do feel free to ask questions throughout by typing them in, and we will get back to you at the end of the session with some of the responses if we have time. Before I introduce some of today's presenters, I was going to actually ask a couple of questions to set the scene. So if you can just look at the screen now and see here, the question is asked of you, do you use hybrids with your clients? Please take a moment to vote on that. Thank you very much. I'm just going to close that off now. Second question I have is, what % of your client portfolios are held in hybrids at present? Please vote those, and I'll be showing the responses in just a minute. Thank you very much. I'm going to close that one off. And then finally, how do you currently classify hybrids for asset allocation purposes? Equity, fixed income, or other? And thank you all very much for that. So let me just show you the responses there. The first question we asked is, do you currently use hybrids with your clients? And you can see that this is a reasonably large sample of advisors, so I think you must say they will be quite representative. About 70% of you are currently using hybrids. The next question we asked is, what % of your client portfolios are held in hybrids? And you can see it's a bit more varied, but the majority still are saying between 0 and 10%, and obviously that roughly 30% that don't use it, and a full 20% using more, so 11 to 20% there. And finally, and this is what we think is critical, how do you currently classify hybrids for asset allocation purposes? And while there is a majority of 46% classifying them as fixed income, you can see the answers vary dramatically, and that's very much one of the reasons why we decided to launch this fund. There is a lack of general uniformity around how people treat hybrids, and it's interesting to see that's come out in the survey. So just in terms of our session today, we've got two great presenters. We have Joye. He's the co-CIO and portfolio manager of Coolabah Capital Institutional Investments. He may well be familiar to many of you due to his regular column in the AFR. He's a contributing editor of the AFR. One of the foremost experts in bank structures and fixed income securities, formerly with Goldman Sachs, the RBA, and UBS. And he's joined by Peter Harper, our Director of Distribution and Head of Capital Markets, who was formerly with places such as Macquarie Bank and ABN AMRO. Thanks very much for joining me both. Today, the session will describe the current valuation environment for hybrids. Is it overheated or a buying opportunity? The challenges that many investors and advisors have in directly investing in hybrids, and we will take the opportunity as well to talk more about the strategy behind our Active Australian Hybrids Fund, HBRD. So we'll just jump straight in, and I'll ask Chris to take us away.
Thanks, Alon. Appreciate it. So we might just turn to the first slide that I'll be talking to, and that is, what are hybrids? It's an interesting question. It seems like a lot of folks on the call have very different views. Some think their equities, other debt. We run about $500 million today of hybrid money spread across traditional ASX hybrids and unlisted subordinated bonds for insto clients, and they also are split between classifying as equity and debt. The debt characteristics are the following. The first is that you actually do rank ahead of ordinary shares in the capital structure. The second is that you do have in normal circumstances, defined income return. And the third is that there's an expectation, perhaps misplaced, but there is an expectation that there will be some sort of repayment date, either on a call date or an exchange into shares through a mandatory conversion date. There are also important equity characteristics. The first is that these are perpetual securities. Secondly, the income is only a voluntary distribution most of the time on these hybrids. What that means is the issuer can stop paying income. That's not true of subordinated bonds, where the income is actually interest and non-voluntary in that respect. And then finally, many hybrids, if not most, can get converted into equity. If the APRA regulator declares a non-viability event, or if the equity ratio of the issuer falls below a certain level. Notwithstanding that, hybrids do currently offer a pretty attractive risk-return profile, and here we have some interesting analysis dating back to 2012 when we started investing in the market. The reason that's interesting is this period's been punctuated by very large credit shocks where hybrid spreads have blown out aggressively in 2012, the taper tantrum in 2013, in June 13, and then we had big blowouts in spreads again in 2015 and early 2016. And I'm not sure if you can make it out on the screen, but I'll just highlight a few points. Based on the selective ASX Hybrids Index, which is a new index, which is a market cap weighted, independently calculated index of all listed hybrids, since 2012, that returned, accounting for franking, 6.35% per annum with a yield of 5.34% per annum. And the volatility of that market was just 2.25% per annum. So those returns far exceeded anything you could get in fixed income. We have various fixed income benchmarks. But if you look at the floating rate note market, that did about 4.5% per annum over the same period. So just under a 2% per annum inferior return. But it came with much lower volatility of 0.43% per annum. If we look at the fixed rate market, that's done about 4.8% per annum with a yield of 2.5% per annum. But interestingly, very similar volatility of 3.3% per annum. So the hybrid market on the ASX over the last 6 or 7 years has actually significantly outperformed all bond benchmarks, but with lower volatility than the composite bond index or a fixed rate bond benchmark. That's at 2.25% per annum standard deviation I'm referring to. So we've actually given you, in this sector, better returns than bonds, in some cases with higher risk, in other cases with low risk, as measured by the standard deviation of the returns. Compared to the equity market, the story is a bit different. Grossed up for franking, the equity market's done 12.3% per annum with a yield of 5.7% per annum. So the hybrid market's given you a very similar yield to equities at 5.3%, but it hasn't given you the same equity upside. The flip side of that coin is there's been radically lower downside risk. So the volatility, the annual volatility of the ASX equity market has been about 13% per annum compared to 2.3% in the hybrid market. And the worst drawdown in equities since 2012 has been 16.7%, very significant, versus only negative 3.8% for the hybrid market. So compared to equities, lower returns but much lower risk. Compared to debt, generally much higher returns with generally higher risk. Which, just the preceding slide, thanks Alon, which makes for potentially attractive diversification qualities. You can't actually see this on your pack, but if you look at the correlation between the hybrid market and floating rate bonds, since 2012, the correlation's only been about 11%. So a very, very low correlation, with the FRN index. If you look at the correlation with the traditional fixed rate bond market, it's actually been negative 9%, so close to zero and slightly negative. And the correlation with the equity market hasn't been overly high at 34%. What that means is that in a diversified portfolio, the low correlation characteristics of hybrids, given they truly are a unique position in the capital structure, sitting between equity and debt, potentially offers diversification gains. If we now look at the performance of the market in terms of spreads, this is going back to 2004. It's really interesting. So this is basically the average major bank margin for their AT1 or additional tier capital 1 hybrids listed on the ASX, sourced from Bond Advisor. And you can see that AT1 or major bank hybrid spreads prior to the GFC were less than 1% above the 90-day bank bill swap rate. Today, spreads on major bank hybrids are sitting around 3% above that 3-month bank bill swap rate. That's interesting because that's about 100 basis points or a percentage point wide of the 2014 tights, where spreads got down to around 2.3% to 2.2%. That's quite anomalous for global credit markets. So if you look at almost all other parts of the capital structure, senior bonds are trading at levels close to 2014 tights. Sub-debt, major bank sub-debt is trading way inside 2014 tights. Major bank equities are obviously quite expensive, notwithstanding the recent retracement. And in global credit markets, spreads are generally at pre-GFC tights. So US investment grade bonds are trading on spreads in line with 2007 levels. So the 2007 equivalent here is 1%. And yet we're at 3% today. So relative to other parts of the capital structure, hybrids look quite attractive today. We've also had a substantial improvement in the quality of bank balance sheets. So they've raised about $40 billion of equity. That's a transfer of wealth from shareholders to creditors because they're reducing leverage and reducing risks. They're also selling non-core businesses. ANZ's getting out of Asia. NAB's got out of the UK. They're selling life businesses, wealth businesses. These are becoming lower risk concerns. The Royal Commission will only amplify that risk aversion, which is bad for shareholders, but good for creditors and hybrid holders. We now move on to consider some of the challenges when investing in the space. There are a couple of key things to think about. The first is this is an incredibly inefficient market. So as I mentioned, we're running $400 to $500 million worth of hybrid capital today. And one of the things we notice trading in the over-the-counter bond market, trading in the listed ASX market, and in trading in global hybrid markets overseas is that the ASX retail market is incredibly inefficient. These are pretty safe securities in the sense that they rank above equity but below debt. But they're also very complex, very hard to price. And that manifests in the retail flows we see intraday, all day, every day. We're generally opportunistically making markets in up to 40 ASX securities and hundreds of OTC securities. And what is very, very clear is generating alpha or finding cheap hybrids and selling them at higher prices is very easy in the ASX listed market where you have that noisy retail flow. The next thing to think about is that most hybrid investors tend to be very passive. We're typically much more active. So we're very valuation centric, and if a hybrid's expensive, we will sell it. Where if it's cheap, we'll buy it aggressively. Most folks don't do that. They're more hold to maturity. Another factor to consider is they are supremely complex securities. So whilst the volatility is less than a third of the equity market, how do you price APRA's non-viability clause, where APRA can write them off or convert them into equity? How do you price the risk of the issuer's equity falling to 5.125%, at which point the hybrid automatically converts into equity? How do you price this so-called inability event, which is a clause in these securities, when again they get automatically written off? Generally, how do you price the probabilities of default and recovery rates on these securities? That's really, really hard to do. And I guess our view is you need experts who are solely focused on that activity to properly manage these portfolios. Another challenge is that most folks have a pretty concentrated holding. There's about $55 billion of hybrids, including Basel III subordinated bonds and preferred equity securities outstanding in Australia. In the listed and unlisted markets, there's about 600 or 700 billion outstanding globally. But typically retail portfolios will have 3 to 5 securities. The final point is that illiquidity can be a challenge. It's very hard for retail investors to find where that $55 billion worth of hybrid capital is actually held. Where are all those dark pools of liquidity? How do you cross up with them? How do you trade with them in large volume? How do you get access to that liquidity? And what do you do if hybrids are expensive and you want to go into other markets like the unlisted, subordinated and senior bond markets? So they're things to think about. In this slide, we're just looking at the risk performance of the market, not on a volatility basis, but rather on the worst case drawdowns. And the black line is the ASX hybrid market, and the brown line is the major bank stock market. And this is through the GFC. And here you can see that hybrids, they have low volatility, but they're not riskless. So even if you were diversified across 40 to 50 securities, your peak to trough drawdown in 2009 was 26%. Having said that, that was a hell of a lot better than the circa 50% drawdown in bank stocks. And we can see on the next slide that timing can be extremely important. So on this next slide, we're showing 2 hybrids, and we're showing the spread that they pay investors and how this changes over time. And what you can see is in 2015, for these 2 crown hybrids, spreads were pretty stable, around 4 to 5%, moving up towards 6%. But they blew out aggressively in February 16 to around 14 to 15%, and then have subsequently compressed. So folks might remember we were quite negative on the hybrid market in 2014. I wrote in the AFR that you shouldn't buy CBA PD. They issued CBA PD on a spread of 2.8% above bank bills. We said that was a dud deal. And we actually had no exposure to the sector at all at that point. But when spreads started blowing aggressively wider, you can see in this chart, it's really over late 2015 and early 2016. I wrote repeatedly in the AFR that I thought those securities had become cheap and they were worth buying. And we certainly started buying in early 2016. And if you avoided that big blowout in spreads, you would have avoided tremendous capital losses. So CBA PD traded from $100 in October 2014 down to $84, slugging investors with 16% capital losses. But since that time, it's performed really well, and it's trading up around almost $100 today. Not all hybrids are equal. So there are many different types. There are corporate hybrids, bank hybrids. There are subordinated bonds that are Basel II subordinated bonds with no non-viability clauses. There are Basel III subordinated bonds with non-viability clauses. Then there are the AT1 or preferred equity or capital note hybrids that have both non-viability clauses and also have the 5.125% capital triggers. Our perspective is that pricing all these securities all day, every day is a awesomely complex exercise and beyond most retail punters. Final point that we've mentioned relates to illiquidity. What this slide is showing us is the bid-ask spread for CBA shares as opposed to different hybrid securities. The spread for the shares is very, very small, as you'd expect. On the hybrids, it's much wider. And one of the things we really focus on is trying to optimize our liquidity. We'll hear more about the solution, that is the hybrid ETF, shortly. But very, very importantly, the product can span both the OTC bond market, the cash market, and the OTC hybrid market, in addition to the listed hybrid market. So we're actually aggregating those very liquid unlisted bond markets and the cash markets with the listed hybrid markets, and thereby improving the overall liquidity profile of the product as compared with a pure ASX listed hybrid holding. Another thing we do is we focus on maximizing the number of counterparties we can trade with to access all those disaggregated dark pools. So we're actually executing with between 30 and 50 different dealers and brokers in the unlisted bond market and on the ASX. And finally, we have access to the substantial ASX crossings market, where you get much more liquidity than what you see in the ASX screens, where people are typically trading in $1 to $2 million parcels. So without further ado, I'll hand over to Peter to introduce the product.
Thanks very much, Chris, and thank you for the earlier intro as well, Alan. And most of all, thank you to everyone for taking time out of their day to listen to us here. We do appreciate it. So we'll look now quickly, and I will be brief on this slide because Chris covered many of them earlier, but we just wanted to cover off on the potential problems with holding hybrids directly. So as Chris said, we're talking about a relatively inefficient market prone to regular over and under valuation, and most investors, pretty much all investors, do not have the ability to accurately price these securities and identify that over and under valuation. What does that do? Quite simply, it creates a great environment for alpha for an active manager. Secondly, most investors holding hybrids tend to do so fairly passively, and therefore if hybrids become overvalued and risks to capital arise as a result of that, most people do nothing about it. An active manager that can identify that overvaluation can switch from expensive securities into cheaper ones, or move further up the capital structure in order to mitigate those potential risks to capital. Hybrid securities are complex. Very few people have a detailed understanding of exactly what all the terms and conditions are across all hybrids in their portfolios. It is the job of a professional manager to know that inside and out and know what each of the risks and potential benefits are of each security and how to accurately price each security on a relative basis. The fund can offer diversification of currently a circa 35 security portfolio, although it can range between about 20 to 50 securities. That is substantially more security diversification than what we hear advisors holding directly, which is generally in the range of 2 to 5 securities from the feedback we've had. And finally, because of the passive nature of most hybrid holdings, that's one of the key factors affecting the on-screen liquidity, and Chris touched on it then. He has access to the crossings market. He has access to the major players in the hybrid space and is able to find liquidity in the market that isn't shown on the standard bid and offer for these securities. The next slide we'll just actually skip over. It's the potential solutions of the fund, but we largely just covered that, but it's there in the presentation for your benefit at a later point in reading. So the fund is the BetaShares Active Australian Hybrids Fund. And I highlight again an active hybrids fund, not a passive investment, because we think active is critically important in this space. The ticker for the fund is HBRD. The fund is currently holding about 35 hybrid securities, and it has a gross income of just over 5% running yield, which is bang in line with the yield on a gross basis of the broad Australian hybrids market. The fund's management fees are 55 basis points, plus a performance fee of 15.5% of performance above the Sol Active Hybrids Index net of fee. Now, I just want to touch on a couple of points here, because there's basically no situation where investors can be worse off as a result of performance fees. And what they do allow us to do is dramatically reduce the base fee that would otherwise sit in this space. So many active fixed income exposures have fees, at up into the 80 odd basis points plus range. By putting in a performance fee, we're able to reduce the base fee down to 55 and transfer performance risk from you, the advisor and investor, through to us, the manager of the fund. So we only get paid, we charge you less up front, and we only get paid if we actually deliver what we say we will. So the performance fee is simple. 15.5% of outperformance net of fee of the index. The second point to note is we don't get paid a performance fee just for beating the index. We are subject to a high watermark. So if we outperform but we still lose money, but we just lose less than the index, we need to make that back up and actually be ahead in an absolute return sense before we are able to collect that fee. So there is no situation where an investor can be worse off as a result of that fee. Moving on to some of the other objectives of the investment strategy of hybrids, HBRD. Our objective is to provide returns after fees that are greater than the Australian Hybrids Index. That hybrid index is every listed hybrid security in the market as defined by ASIC, market cap weighted. So we want to try and do better than the broad hybrid market. We have an absolute return objective, and that is post-fee to provide a return that's better than or greater than the RBA cash rate plus 2.5% over the medium term. So capital preservation is very important in the way we look at this fund. We understand that people do not want to give up income from hybrids, and therefore we have an objective to provide a franked running yield that is generally similar to that hybrid index net of fee. And finally, we want to target volatility that is in that range of 3 to 4% in line with the broad hybrid market. You'll also note here that risks of rising interest rates are mitigated through this product by the fact that it only invests in floating rate exposure. Very last point is around capital preservation. The manager here, and we think very importantly, has the ability to go to 100% cash or bonds if hybrids are materially overvalued or if they see risks to default in the hybrid market. Above all else, we want to try and protect your investors' capital. From that respect, we often refer to this as a capital structure ETF as much as a hybrids ETF. And that is something that is very, very difficult to do through direct portfolio holdings if you don't have the valuation tools that are available to Chris and the Coolabah Capital team. In terms of how the portfolio is expected to be run across normal market environments, a core of the portfolio is expected to sit in ASX hybrid securities. That is to help us achieve the income objectives of the fund, which are to provide income similar to the broad hybrid market. It is worth noting that those securities being actively managed mean Chris is obviously and his team constantly monitoring the valuation of those securities and trying to ensure that they're getting out of securities that are overvalued and remaining in securities that are undervalued within that space. The portfolio is then augmented with cash, senior bonds and subordinated debt around the satellite exposures. And they assist with with a few key things. First of all, they assist with capital preservation, enabling us to move more towards those areas when there might be risks from a valuation or default risk perspective in the hybrids market. Secondly, they still allow the opportunity for alpha generation by being able to de-risk at times where hybrids do show risk. And thirdly, they can add substantial liquidity to the portfolio relative to just holding hybrid securities. We've largely covered the next slide, I think, but you'll see here why we've given the flexibility to roam across the capital structure here. The one thing we can't be invested in is direct equities, but beyond that, the fund can roam from hybrids up to all the way up the capital structure, subject to meeting the objectives that we've outlined in the previous two slides. This really exists from the point of view of mitigating risk to capital. I'll just pass back to Chris now, and he can give you an overview on Coolabah as an investment manager.
Thanks, Peter. At Coolabah, some of you may know us through our Smarter Money Investments brand. We run about $2.2 billion today. Some folks think of us as a retail manager. Actually, about 90% of that money is institutional, from mainly super funds, universities, and other asset managers. Within the team, we have 4 portfolio managers full-time, 4 full-time analysts, 3 of those are quant analysts, and we own our business. That is to say, the investment team owns our business. We have co-invested in our portfolios about $80 million. We've been running portfolios that can invest in hybrids as we've defined them, using the ASIC definition that captures subordinated bonds since 2012. Over that period, unfortunately, we don't have this particular chart in the pack, but if you look at the performance of our bond portfolio since 2012, over the last 6 years, we've outperformed the hybrid market by 2 to 3% per annum over the last 6 years, with actually only a modest exposure to that market. Many of our portfolios work in a similar fashion to hybrid. Many of our portfolios have that ability to roam up and down the capital structure according to how we see relative value. So what my team of analysts and PMs are doing are revaluing every unlisted bond and every listed bond and hybrid every second of the day. We're trading up to 50 times a day. We're often doing $200 million worth of trades a day. But what we specialize in doing is valuing securities. How do we value them? We have 10 to 20 different valuation models, all internally built. But the models are trying to do one simple thing. They're trying to figure out what is the fair value rate of interest or spread or hybrid yield that this security should pay me, given its term to maturity or expected call, given its credit rating, officially or implied otherwise, given its position in the capital structure. Is the covered bond, a senior bond, Basel II subordinated debt, Basel III sub-debt, or AT1, given its issue size, given its industry sector, and so on. So we're running all these models in real time, and they're basically saying this is a fair value rate of interest on a security that it should pay you based on the features of the security and the financial fundamentals of the issuer. And simply put, we're looking for securities that are paying spread beyond that, excess interest beyond that. They're the cheap securities. It's kind of like in equity terms, looking for stocks with high dividend yields that are paying excess yield and are trading too cheap. When that yield or spread compresses back to our fair value target, the price will appreciate and we'll actually get a capital gain. And that capital appreciation will augment and supplement the return we earn on the bonds and hybrids. And that's what we do all day, every day. We have had consistently an ability to generate these excess returns over time. So we just skip ahead. This slide is just showing on one institutional mandate that we run the month-to-month excess returns that we've earned in 2017 relative to the index. That's interesting, but it's just a short period of time. If we go forward, Alan, to the next slide, we can see here, this is an analysis of the implementation costs of an institutional hybrid mandate that we implemented this year for a $160 million client. And you need to focus on the blue line. The blue line just compares at the end of each day the purchase prices we paid relative to the closing price or the closing VWAP. And even though we had to pay brokerage and we had to cross spreads, you can see the blue line's positive and it grows through time. What that shows you is purely through executing and implementing that $160 million, on day one we were generating excess returns or positive alpha. If we go to the next slide, Alan, this is a more scientific analysis, and you may not be able to see it clearly. I can explain it myself shortly. Basically, what this analysis looked at was every single trade we've done in our longest standing portfolio, Smarter Money Active Cash, since 2012. And this is a portfolio that can invest in Basel III subordinated bonds and senior bonds and cash, just like hybrid. And the key point here was that there were 850 exits over this 5-year period, and our win ratio was over 97%. So we're getting positive total returns over 97% of the time. Just above the win ratio, you can see a number there, 84.8%. That's the percentage of the time when we sold a position that we got capital gains. So we were generating capital appreciation through finding mispriced bonds and subordinated bonds where spreads compressed and mean reverted back to our fair value targets 85% of the time. The key point is that on an annualized basis, our capital appreciation accounted for about 4% per annum, and our total returns on this bond portfolio was about 10.6% per annum over this 5-year period. This is all pre-fees, and this is ex-cash, so it's exclusively within our bond book. The takeaway is that across a very, very large sample of 850 exits, we have very high win ratios with a proven ability to generate mispricings that deliver capital gains, and those capital gains account for about 40% of our returns. Just to give you some specific examples, we're now looking at a CBA subordinated bond. This is a Basel III subordinated bond last year, in or around Brexit. Our model said fair value was 233 basis points over bank bills. The spread on the bond blew out to 275 basis points over bank bills. So we picked up the bond here. It was only paying about 4.1% interest. But because over the 2-month holding period, we picked up a almost 200 basis point capital gain, the internal rate of return on the trade over the holding period annualized was about 18%. If you go to the next slide, here you can see a Bank of Queensland subordinated bond. This is a floater as well. This priced last year at 340 over bank bills. We had fair value according to our models, accounting for the credit rating, the maturity, the issue size, the liquidity, the industry sector, and the capital structure position. We had fair value at about 270 to 280 over bills. You can see it popped on day one, and the spread compressed to under 280 over, and we picked up almost 300 basis points worth of capital gains. The bond was only paying 4.45% interest, but the annualized IRR over the holding period, because we're trading up to 50 times a day and every one of our holding periods is different, we need to always talk and work in internal rate of return terms, which normalizes returns from each trade. But the IRR on this trade for the holding period was about 14%. Another example that's not in the pack is a Challenger subordinated bond that actually listed about 2 weeks ago. They issued at 210 over, 210 basis points over bank bills. We had fair value at 172 basis points over bank bills. Today, it's 185 basis points bid. So you've had a 25 basis point compression in spread. This is a 5-year Tier 2 subordinated bond issued by Challenger Life. And that's already delivered over 100 basis points of capital gains in a couple of weeks. So this is generating outperformance or alpha, not through dialing up credit risk, not through dialing up illiquidity risk, and not through investing in long-dated fixed-rate bonds. What we're trying to do is generate excess returns that beat the market through finding mispricings by applying a very, very rigorous and sophisticated suite of valuation tools. We would argue we are the most expert pricers of these securities in the market. We're often engaged by issuers before they launch a hybrid security to help them price it. I had a major bank in my office yesterday talking about, potentially pricing both senior bonds and hybrid securities. And that's our core competency, pricing assets in the bond and hybrid markets. Since we launched hybrid, since the 13th of November, we've launched the ETF on the ASX. It's grown quite quickly. I think it's approaching $15 to $20 million already. But we've had to put that money to work in the ASX. So we've had to pay brokerage and cross spread. And we're already, notwithstanding the fact that every day when cash comes in, we've got to pay brokerage and cross spread, we're already beating the ASX hybrid index, net of management fees and performance fees, by 41 basis points over the last one month period. So we're pretty proud of that outcome. The slide that is on the screen right now just shows you in some of our current portfolios that have the ability to invest in hybrid, sub-debt, senior and cash, that our monthly cash weights vary quite dramatically. The blue bars on those two slides are the cash weights. The slide on the right is a newer portfolio that's 3.5 years old. The slide on the left is a portfolio that's 6 years old. But you can see at various points in time in that slide on the left, the chart on the left, we've been about a quarter of the time below 30% cash, and about 30% of the time we've been above 60% cash. So we have very much absolute return in the 8 different portfolios I run across the $2.2 billion we manage. In every single portfolio, people pay performance fees. In every single portfolio, I can go 100% cash because we refuse to hold expensive assets. So when assets are expensive, we either hedge that risk or we exit that risk. In the hybrid market, we can hedge it using equity options. And in the credit markets, we can use the iTraxx index, which is a synthetic derivative to hedge credit risk. I think we've pretty much talked through most of the remaining slides. Happy to go to questions. I think I just conclude on, from my perspective, a few key points. The first is this is an active portfolio. We already have a unlisted bond in that portfolio, which is that Challenger subordinated bond that would not otherwise be accessible to retail investors who can only access the ASX market. We're very focused on beating the ASX hybrid market, but also delivering an absolute return that beats the cash rate plus 250 basis points. As Peter mentioned, the current portfolio yield, whilst we're fairly fully invested, we've got 37 hybrids in the portfolio today, pumping out a fully franked yield of about 5%. We do have 5% of the portfolio in the cash realm and a percentage of the portfolio in that unlisted subordinated bond. But notwithstanding that, we've been able to generate that outperformance that we mentioned, that 41 basis points net of fees above the index. So we're focused on delivering on all of our return benchmarks, beating the market, beating the absolute return benchmark, and also providing a through the cycle fully franked yield that's comparable to the market. Understanding that if hybrid spreads were to compress back down to 200 basis points, we're likely to have much less exposure to the market. And at that point in time, our fully franked running yield might be below the market in the name of preserving capital.
Thanks for all those points, Chris. Just before we go to questions, I just need to do a very quick recap here. And in answering that recap, I've often been asked the question already just in the first couple of weeks, of why HBRD relative to direct hybrids. And hopefully we've answered many of those questions across the course of today. But I actually think it's quite interesting to turn that question around and actually say the opposite. Why direct hybrids over HBRD? Because when you think about it from that perspective, direct hybrids do not, unless you have the valuation models and ability to value these securities intraday from a fundamental point of view and a default risk point of view, which most people don't, then direct hybrids are not giving you the opportunity to participate in potential alpha that HBRD does. Potentially, direct hybrids do not benefit from the risk mitigation that Coolabah Capital's valuation models can give. So by that, I mean direct hybrids, if they become overvalued, most people wouldn't even know about it and don't have the ability to mitigate risk to capital that HBRD gives them. Direct hybrids have complexity of understanding the terms of issuance. That problem is solved by putting that issue in the hands of a professional manager who looks at these issues day in, day out. Direct hybrids don't give you the monthly distribution that HBRD does. Direct hybrids don't help manage the default risks that HBRD does. And direct hybrids don't give you the diversification for most portfolios that HBRD does. So we think that it provides a really nice way to both simplify portfolios, but also potentially mitigate risks and add alpha, all of which we find quite attractive. Just some final things to keep in mind. Investment risk, of course, exists. Investment returns are uncertain and will be influenced by the performance of markets as a whole and other risks. Income payments are variable. If interest rates fall, HBRD's income payments can be expected to fall too, and vice versa. Obviously, though, the floating rate exposure helps protect against risk to capital from rising rates. Hybrids are, by their nature, predominantly issued by banks, creating sector concentration risk. We are exposed to the credit risk of issuers, and hybrids rank behind all debt and deposit holders in the event of issuer default. But having the flexibility to move up and down the capital structure may help the manager deal with those risks. Hybrids are, of course, complex securities and terms differ greatly. Investors should seek professional financial advice and read the PDS prior to investing.
Awesome. Well, thank you so much for that, Chris and Pete. Really useful, and we had a whole lot of questions. We'll do our very best without taking too much of your time to answer some of those. Also, just wanted to let you know, obviously, more information on the hybrid fund is available on our website, so please do check that out. And for those of you that have a BetaShares client representative, advisor services representative, please do reach out to them. We'll try and take some of these questions. Chris, one for you here, a bank hybrid. If they may not pay income, wouldn't they have to stop paying shareholders before they did this? So in other words, in what circumstance would a bank hybrid stop paying income?
Yes, there is normally what is called a dividend stopper, which means that in order to stop paying income on the hybrid, they would have to stop paying dividends on the shares. Of course, you could have a situation where there's a non-viability event where you're automatically and unilaterally converted into shares or written off before any of this happens. Not many people realise that APRA also last year introduced new rules that stop banks paying profits to shareholders as dividends and income to hybrid holders once their capitalisation falls below certain pre-specified levels. APRA basically starts garnishing or restricting the bank's cash flow from being used for dividends or distributions. That kicks in currently at an equity ratio of 8%, and the magnitude of the restrictions increases at 7.125% equity, and then again at 6.125% equity. At 6.125% equity, a bank is restricted from paying out 80% of its profits to either equity or hybrid holders. Okay?
Great, thank you so much. So another one for you, I think, Chris. How many non-viability events have occurred with Australian banks historically? That's a question from Max.
We haven't yet had any non-viability events in Australia because they were basically introduced, the so-called non-viability clauses, from 1 January 2013. And fortunately, we have some of the best capitalised and strongest banks in the world. We have, however, seen non-viability events in Portugal and Spain that have wiped out hybrid holders. Actually, in Spain, they wiped out the AT1 hybrid holders and the T2 subordinated bonds. In Portugal, they wiped out the senior bond holders. It's one of the reasons that we don't invest in any overseas hybrids because, frankly, we don't trust the vagaries of those capricious regulatory regimes. If we go back in time and we ask the question, have Aussie banks blown up? Yes, it has happened. I think the mitigant today is since the GFC, the government for the very first time has guaranteed the bank's deposits. For the very first time, the government also guaranteed their bonds. They've now removed the bond guarantees, but would probably roll them back out in a future crisis. And the banks receive much better near unlimited liquidity from the RBA. The last time, for the historians on the call, an Australian bank creditor lost money from recollection. This is stretching my memory, but I do believe it was 1931, the Primary Producers Bank. And obviously that bank doesn't exist today. And I think depositors suffered a circa 5% haircut.
Okay, so question from William. Why have institutional investors traditionally shied away from the hybrid market? I think that's for you too, Chris.
Yeah, so it's definitely true. Aussie instos have boycotted this market for many, many, many years. That started to change about 2 years ago. We saw UniSuper, a massive super fund, whack $200 million into a single CBA hybrid off its balance sheet. And I run 2.2 billion and 90% of that comes from instos, and we invest in hybrids. I run dedicated hybrid mandates. I run a $220 million hybrid mandate for one super fund. And I've been approached by 2 other super funds to run similarly sized hybrid mandates. There is a big increase in insto appetite for hybrids because super funds are nervous about equity valuations, and they legitimately see hybrids as a good way to step up the capital structure from, say, bank equities and to access decent returns with those defensive properties, namely the 1/3, the level of the volatility, that is roughly 1/3 the volatility of bank and overall equities, and significantly lower drawdowns, about 50% of the drawdowns in any existential GFC style crises that we saw in 2009. So institutional appetite for hybrids is, I would say, increasing quite dramatically, and I expect that to continue to be the case. I think people have got more comfortable with the hybrid market. Another thing that's prevented instos investing in hybrids has been the fact that in Australia, they're almost all ASX listed. Overseas, that's not the case. Of the north of $600 billion of AT1 and Basel III Tier 2 that trades overseas, almost all of that is OTC. And that's an insto market. I believe we will see more over-the-counter hybrids that we can allocate to in this ETF in time, and that will bring in more insto capital, and you'll see more insto market makers.
Excellent. Right. Now there's a question here that's quite a technical one. It's asked, will TLAC, which I think is total loss absorption capacity, lead to higher hybrid issuance?
So will TLAC, it's a new banking rule, result in more hybrid issuance? I can see there's about 400 or 500 people still waiting on the call, desperate to hear the answer to this question. But the short answer is that no. So I'm a bit of a TLAC expert. We've advised the banks on TLAC, spoken extensively to APRA on TLAC. We're likely to see total loss absorbing capacity satisfied in Australia through a new Tier 3 bond, which sits between senior and sub. We could invest in that, in theory, in the hybrid ETF because we can invest in anything in the capital structure other than equity, but it won't increase the issuance of AT1 or Tier 2 because they're very expensive securities for the banks to issue. The banks have really maniacally avoided issuing Tier 2 this year, Tier 2 sub-debt, precisely because it's very expensive. They're trying to reduce their funding costs. They're trying to maximise their net interest margins, and they're trying to optimise their return on equity. So they want to do that as cheaply as possible, and Tier 3 will be much cheaper than hybrids. Okay,
we've got a question here about, for you, Peter, just how often distributions and income are paid on this fund.
Thanks, Alana. I did just cover that right at the death, I think, but distributions are paid monthly, which is probably more frequently than most directly held hybrid securities, so good for managing cash flow for investors.
Okay, another question here. I think there's a couple of people on this call who are familiar with your Smarter Money High Income Fund, and in fact, there was another one there, the Smarter Money Active Credit Fund. I think it is SMAC. The question on both fronts is, how does this fund differ from those two funds? And
there was also a question that asked, what experience do we have running hybrids? So as I mentioned, we've been investing in Basel III subordinated bonds since 2012. We've been investing actively, or had the ability to actively invest in ASX hybrids since 2014. Today we run about $400 million of sub-debt and hybrid exposure, AT1 exposure, across our portfolios. As I've mentioned, some of those are dedicated insto mandates. So I have one $220 million mandate dedicated to that space. We've consistently, in our bond portfolios, if you strip out our cash, we've smoked the hybrid market by about 2 to 3% per annum over the last 6 years. In the BetaShares product, as I've mentioned, we're 41 basis points already above the index. In that 220 mil mandate I run since inception, annualized, we've been doing north of 2 to 3% per annum above the index. This product is very different to active cash. So we run two other strategies that relate to this. Smarter Money Active Cash cannot invest in AT1 hybrids, so that's fundamentally different, but it can invest in Basel-free sub-debt. Smarter Money Higher Income can invest in everything that this ETF can invest in, but the hybrid weight's much lower. So Smarter Money Higher Income's average hybrid weight since inception has been about 3%. Currently it's sitting around 7%. It's limited to invest no more than 15% in AT1 hybrids. So we can access the same assets, but the portfolio composition is quite dramatically different to hybrid. If you look at hybrid today, as I've mentioned, we're 95% invested in hybrids and sub-debt, 5% in cash, and we're probably about, I think, 85% in AT1 hybrids, 10% in sub-debt, and 5% in cash. That's very, very different to any other portfolios we run, other than, interestingly, the super fund mandates I run, which are also hybrid mandates but have the freedom and flexibility to roam up and down the capital structure. They are very, very similar to hybrid, the ETF. We do not offer any other retail strategies like that, and we don't plan on offering any other retail strategies like that other than through BetaShares and this landmark active ETF product.
Thank you so much. So probably just time for two more. Peter, it's really just a question about liquidity, really. Ultimately, the question is about liquidity and how does this fund offer liquidity when many investors are selling hybrid at the same time, or for that matter, buying hybrid at the same time?
Okay. So the fund is an open-ended investment, as are all ETFs, including this active ETF. In terms of the liquidity, it's important to remember the liquidity of any ETF is based on the liquidity of the hybrids market. And there is no question that that applies here too. So is the hybrids market as liquid as the ASX 200? No, it's not. So you wouldn't expect liquidity in this product as strong as in the ASX 200. But the point I want to make is this. If you think about what is the liquidity of the hybrid market, the liquidity of the hybrid market tends to be different for different types of investors. For advisors buying and selling on screen, the liquidity they see and the liquidity they can readily access in hybrids is in all likelihood substantially different to the liquidity that a professional manager like Coolabah Capital can access. Coolabah has access to the crossings market and regularly trades in the crossings market. They make up a substantial part of that market, and I'll just hand over to Chris. He can discuss that in a bit more depth and with his experience.
I think the key point for this ETF is we're pooling the liquidity in the $1.1 trillion investment grade bond market here in Australia with the liquidity on the ASX. So there's roughly about $55 billion of ASX and OTC hybrids, but we can also invest in senior bonds, covered bonds and cash. So we're basically harnessing the tremendous liquidity that we see in the unlisted bond market, where I can trade 50 to 100 million bucks in a heartbeat, like literally in seconds in major bank senior, where I can trade, like today, literally I traded, we bought $16 million of tier 2 subordinated bonds in the space of probably 4 minutes. I'm harnessing that liquidity and fusing it together with the relatively inferior liquidity that we're seeing in the ASX market. But as Pete noted, we trade with more counterparties than any other investor in the market, up to 50. We have access to the crossings market, which you don't see in the screens. And the idea is to provide a overall hybrid portfolio exposure that is much, much more liquid than what you would get if you're a retail punter or an advisor trying to manage that stuff directly on the ASX.
All right. I think I'll just ask one more, which is, well, there's one very short one and maybe one a little bit longer. I think it'll be a nice way to wrap up. So the first one is, I think it was covered with Peter or Chris for that matter. Is there a reasonable expectation that there'll be outperformance? There's an objective for outperformance. I'll let one of the two guys please answer that question.
Yeah, so we are definitely targeting generating excess returns above the ASX Hybrid Market Index. That's what we've done in our other portfolios over 6 years. And we'd be looking to best that index by more than 100 basis points per annum net of fees, which means actually we're besting it by at least 155 basis points per annum.
Okay, so last question, two parts to it. The first one is, Chris, what do you believe are the greatest risks hybrid investors currently face? And second of all, just given that we did ask the audience the question, how should we classify hybrids? The question is, how do you believe we should correctly asset allocation and classify hybrids? So the first one was, what's the greatest risk that hybrid investors face? And then how should one classify hybrids? That's for you, Chris.
Might take the second first. So I'll just focus on asset allocation. I think there's two ways you can, if it was up to me, on asset allocation, you could classify hybrids. I think the first correct way to classify them is in line with their credit ratings. Most major bank hybrids are BB+ rated, which makes them sub-investment grade or high yield. There are some other issuers. Some of the insurers have hybrids that are sort of BBB- rated or even BBB rated. But basically, these are a high yield investment. So they're risky fixed income if you want to classify them as such. They're definitely not core fixed income. They're definitely not bonds. They're high yield. And that's where my insto investors that are allocating capital to us to invest in hybrids are doing so out of their high yield buckets. The benefit of them is they're typically much more liquid than most high yield products. So you look at a Metrics direct loan fund that's got zero liquidity in the actual assets, whereas the assets we hold have very good liquidity, and our yields are, I think, actually probably better than that Metrics Credit Partners yield. And then finally, we can trade these all the time. We understand the pricing. We can generate alpha. If you're investing in a direct loan portfolio, Metrics commits to those loans and then has to hold them to maturity. If they make a bad credit decision and the loan blows up, they're screwed. So having some liquidity, even though it may not always be perfect, is very, very valuable. The other way you could classify hybrids is defensive equities. And we're being allocated from super funds out of their equities portfolios, and they want to move up the capital structure to get equity-like yield. So the fully franked dividend yield on our portfolio today is around 5%. That compares well with most listed securities, but they're not going to suffer the capital preservation, volatility, and risks that you see in outright shares, judging from past experience. In terms of the biggest risks to the hybrid market, I mean, you can talk about this forever, but I think there's probably two key risks. The first is just mark-to-market risks. At some point, this market will be overvalued, and at that point in time, you don't want to own the assets, or you want to try and mitigate and minimize your exposure to those assets. So I think valuation risks are profound. Am I worried about valuations right now? No, not at all. I think the market will grind tighter for a significant period of time. And we think it's the cheapest part of the capital structure. We think it's about 100 basis points wide of fair value. But in order to arrive at a judgment regarding valuation, you need to be able to price the probabilities of default, the recovery rates, the non-viability clauses, the capital triggers, the embedded optionality. That, I think, is a real risk to any investor looking at this space. The second, more intrinsic inherent risk is just the risk of banks blowing up. What's the probability of the CET1 ratio falling below 8, 7.125, 6.125, and so on? What's the probability of APRA pulling the non-viability clause? We have views on all those things, but that's really a subject for another day. We could spend an entire seminar talking around those propensities. There are also offshore risks we saw in February 16 when people thought Deutsche wasn't going to pay, that's Deutsche Bank, wasn't going to pay coupons on its hybrids. That spreads blew wider globally, including here in Australia, so that's another thing you need to be mindful of. I think Australian hybrids are now decoupling. We've had blow-ups in hybrids in Portugal that had no impact on the Aussie market, and I think people understand that this is a very, very well-supervised nation with some of the best capitalised banks in the world.
All right, look, I'll just ask one last question that apparently we get quite a lot, so I'll use the opportunity to answer that for some of the remaining attendees, which is a question from Livio. How would the ETF deal with the conversion of a hybrid to equity given it can't hold equity?
Yeah, pretty simply, we would sell the equity. So we would have to sell the equity. It's the same as bond investors. So it's subordinated debt that sits in pretty much all fixed income portfolios in Australia, has the same risk as the equity conversion risk in hybrids. So fixed income investors can't invest in equities, and they would just need to sell those securities prior to conversion, at the time of conversion, or post-conversion.
Awesome. Well, thank you all very much. It was a very well-attended webinar, and we will be following up with some information on the fund. Look forward to hearing any further questions or queries. And once again, thank you all and have a fantastic end of the year. Thanks all. Bye-bye.